Good evening, everyone. I am CA Hemant Moore, moderator of this VCM. We are delighted to welcome you all in the VCM being organized by the Continuing Professional Education Committee of our institute. It is my pleasure to be a moderator for this session on VCM on recent free trade agreements and CAROTAR rules and compliance of Prevention of Money Laundering Act and AML measures. In a short while, we will start this VCM. Before that, I would just like to apprise you about our CPE committee. The profession of chartered accountancy has always been recognized for the quality of education, training, and strong grip over technical standards. With globalization and increasing business complexities, it is essential that chartered accountants equip themselves with the changes occurring and stand out to the expectations of the society. Our institute is constantly working and contributing to cater to the needs and requirements of our members and has taken various initiatives for them from time to time in that direction. With this view, the CP committee of our institute has always been the foremost to provide opportunities to their members to boost the knowledge base. The program for this evening is as follows. We have two sessions of 1 hour each. And the topics are, the first topic is recent free trade agreements and CAROTAR rules. And the second, compliance of PMLA and AML measures. Our eminent speakers will talk about the above two emerging areas of professional interest. Without any further delay, I would like to start with the event. The first topic for the evening is recent free trade agreement and CAROTAR rules. We are fortunate to have with us a very distinguished and learned speaker on the topic. CA Manas Chugh is here with us. CA Manas Chugh is a chartered accountant and an economics graduate from Delhi University. He was earlier with Deloitte Haskins & Sells and now is leading a consultancy firm and advising clients on the economic laws and taxation laws governing international trade, that is Foreign Exchange Management Act, Foreign Trade Policy, Special Economic Zone, Customs Act, and Free Trade Agreements. He has served various multinational companies in mapping their strategy for investment in India, complying with the FEMA regulations, and assisted in the litigations arising in the customs. He has also assisted multinational companies in developing cost-benefit analysis, focusing on the bilateral trade agreements and CAROTAR rules. And he has also assisted Fortune 500 companies and Indian listed companies in optimizing the benefits under the foreign trade policy. He is also a regular speaker on these areas on various platforms of the Institute of Chartered Accountants of India, news channels, professional institutions, and trade bodies. He has also published various articles on these areas in ICAI journal, newspaper, and magazines. With these words, I welcome CA Manas Chugh to start the first session. Manas sir, please.
Thank you, Hemantji, for this lovely introduction. First of all, I want to thank the CPE committee for inviting me on the topic of free trade agreements and CAROTAR rules. I am actually thankful to the whole committee, which is doing an exceptional work in increasing and improving the education of whole professionals, because we belong to a professional area where we need to update and regulate and update ourselves to educate the clients. So the CPE committee is doing a tremendous work in educating and improving the skills of the whole professionals. So for today's first topic that I will be covering will be the free trade agreements and CAROTAR rules. The trade agreements, basically first I'll just brief about the trade. India, which is part of WTO, that is, which is part of the WTO, is doing wonders in their international trade. But India is still a trade deficit country. That means the import is still more than the exports. In spite of the last year when we all discussed to substitute China in our domestic consumptions, even after such bold moves by the government, still we were trade deficit specifically for China and as a whole trade. This shows that India has tremendous potential in increasing their exports and reducing, and basically not reducing, but substituting the imports. Currently, the current government, they are taking several measures to basically replace the imports with the domestic manufacturing. That means many of the companies are now planning to set up their manufacturing sites in India. Like recently in yesterday's newspaper itself, there was a big news that Apple products, Apple iPhones, many of the Apple iPhones have been started manufacturing in India, and they are like Foxconn and different kind of companies which have been outsourced in production of the iPhones. They are exporting from India now. Earlier, we were wholly dependent on the imports, but now they are exporting from India. This shows the potential of India being a country which is a consumption-based economy, because the best part of India is the population. We are 1.3 billion people. So we have in-house surplus consumption. 70% of the GDP is consumption-based. So this shows that within India, we have surplus consumption. And this implies that many of the multinational companies are now planning to set up their manufacturing sites in India, just like automobile companies, semiconductors, electronic components, mobile phones. All these companies are now planning to focus their manufacturing site in India rather than importing into India. So in this manner, the government is also taking several measures, either by going for the trade agreements, be it free trade agreements, preferential trade agreements, regional trade agreements, or increasing the custom duty. That is basically a measure wherein the imported goods will be expensive than the domestic products. And there are different type of trade remedies, be it anti-dumping duty, safeguard duties, and different type of duties, which basically discourage the imports. So there are different kind of measures which are being taken care by the Indian government. So today we will be understanding the free trade agreement and the CAROTAR rules. Recently, the free trade agreement was in news because India signed two free trade agreements. The first one was with the UAE in the February month, and recently, the last month itself, the India signed the free trade agreement with Australia. So it was a very big news for India because India signed the free trade agreement after 10 years. Earlier, the government policy was little restrictive. They were not going for the free trade agreements because of the past track records of India. India has been trade deficit with the countries with which they have the free trade agreements. So the government was still restrictive. They were not going forward for the free trade agreements. So that is why I believe everyone must be aware of the RCEP agreement. Last year, there was a huge discussion on the RCEP agreement, and India chose to not sign the RCEP agreement. It was world's biggest free trade agreement, wherein 40% of the world's population countries were involved in the RCEP. And India, being a part of the whole world, integrated in the whole world, decided not to go for the RCEP. This shows India was actually resistant because India's population and India's manufacturings are still not developed to basically fight and basically compete with these kind of multinational companies. But the government has realized that without going for the trade agreements, they won't be able to grow, and they won't be actually able to grow exponentially. So that is why the government has changed its policy. They've started negotiating with the free trade agreements with the developed countries. Earlier, they were going only for the developing countries. That means the Asian countries and different kind of countries which are bordering nations. But now they have decided to go for free trade agreements with the developed countries. So that is why they have signed with the UAE now, and also with Australia. And now they are in the agreement. They are in discussion with the UK, United Kingdom, which they are expected to be closed by this Diwali. And also they are in discussion with the GCC and the European Union, and also with the US. These are all in line. They are in line, and they will be closing in the next 1 to 2 years. So I'll be sharing my screen and discussing the free trade agreements and what are basically the CAROTAR rules. CAROTAR rules are basically rules which governs the free trade agreements, specifically in India time horizon. These CAROTAR rules provisions are there in specific agreements also. Like if we discuss about the UAE and India's trade agreement, you will be able to find some kind of provision from the CAROTAR in that agreement. And in that case, because CAROTAR rules basically governs the rule of origin. If, for example, I'm importing from a neighboring country like Nepal, and India has a trade agreement with Nepal. So what happens is there can be a routing of goods from China to Nepal and Nepal to India. So in that scenario, the government has in 2020 initiated with the CAROTAR rules. So in the future slides, you will be covering the CAROTAR rules. I believe the screen is visible to all. So first, we will be understanding the customs law. Basically, through the customs law, the government has been given the power to enact and power to levy the custom duty, the taxes on the import and export transactions through the Customs Act. Customs Act has been divided into two parts: Customs Act 1962 as well as Customs Tariff Act 1975. Basically, Customs Tariff Act defines how much tariff will be levied on the import and export transaction. Import is governed under the Schedule 1 and export is governed under the Schedule 2. And because if we are taking the benefit under the free trade agreement, there will be a benefit or concession in the custom duty. So we will be understanding how the custom duty benefit is arised and which specific section provides the exemption under the Customs Act. So this is basically the customs law, in which the government of India has been given the power to enact and power to levy and collect the duties on the import and exports under the entry number 83 of list 1 to the Schedule 7 of the Constitution. So first I'll be just giving a brief of the India's current trade, and then we will be going forward with the free trades. So India's current trade, India recently, if everyone must be aware of, recently our Honorable Minister CA Piyush Goyal ji specifically mentioned that it was a tremendous year for India because India's exports, merchandise exports was crossed the $400 billion and service exports crossed $250 billion. This was the first time in the India's history that $400 billion India crossed the merchandise export of $400 billion. So this shows how much potential India has. But the issue that arises, the basic objective in which we are increasing the exports, but we are still dependent on the income sensitive items. That means the items which fluctuates on the pricing. That means the petroleum. Everyone must be aware that we are a major importer of the petroleum. That means the crude oil. But we are also the major exporter of the petroleum products. Basically, the crude oil is the raw material, and we produce the petroleum products, and we are the major exporter. The topmost product that we export is the petroleum product. This shows that we are still dependent on the income sensitive item. Income sensitive item means that are sensitive to change in the external demand, rather than going for the engineering or more majorly technical or IT driven things. We are currently focused on the income sensitive items. So that is how the government is also focusing on making the products which are, for example, electronic components, semiconductors. These kind of components doesn't depend on the pricing, but they are dependent on the technology. So India currently is a trade deficit country. That means import is greater than the exports, and it is still increasing. It is not reducing. Last year it was reduced. Reason was the COVID-19. There wasn't much imports into India, but this year the trade deficit is also increased a lot. This is the major imports, that is the crude, gold, because we Indians, we are fond of jewelry. So gold is the second most imported product in India. The first is the crude, that is the petroleum product. Third is the petroleum product. Fourth is the pearls, precious and semi-precious stones, and coal, telecom instruments, electronic components, and different kind of products that are there under the top major imports. The next is the major exports. We are the major exports. The most product that is exported from India is petroleum product. This is somehow shocking for all. That is, petrol products is the product that we export the most. The next is the pearls and semi-precious stones, and then iron and steel, and different kind of products. So what is the current trend that is there in the current international trade and customs? The first is the trade agreements with the developed countries. India has now started focusing on the developed countries. That means negotiating with the developed countries. Just like I told you, we are currently in the discussion with the UK, European Union, and different kind of developed countries. The second is a stricter rule of origin. Ultimately, what the government wants is, because the product is coming into India at a concessional rate of duty, the government is losing its taxes, the government is losing its revenue. And if it's losing its revenue, the government will be safeguarding itself. The government will be focusing on taking measures so that there is no misappropriation, or there is no misdeclaration of the product. So that is why the government has now started focusing on stricter rules of origin. We will be studying in details in the later part. Next is the trade facilitation, because ultimately the world, and also in India, says that trade facilitation, we are a part of the world. So everyone feels that there should be one world, one market. Just like GST, we said one India, one nation, one tax. Likewise, the world says, everyone and each and every country says that one world, one market. So if we're talking about one market, that means we're providing facilitation, we are providing our market access and supply chain benefits and each and everything, so that if, for example, I'm importing from China or Japan, that doesn't mean I'm importing from a different country. I'm importing from a space which is part of us also. So that is why government has started focusing on trade facilitation, like AEO, Authorized Economic Operator. It's a certificate wherein the custom provides and gives specific benefits under the financial as well as procedural benefits. The next is curtailment of benefits under the foreign trade policy. The government has taken a restrictive opinion on the foreign trade policy benefits. That means the incentives that were there under the foreign trade policy, they have started reducing the incentives. They have started replacing the schemes, because the WTO has given some kind of case in which the it was against the India. So that is why the government of India's objective has also changed. They've started reducing the incentives and they are providing this kind of facilitation to the exporters and importers, so that ultimately the procedural benefits is being given to these importers and exporters. Next is focusing on exports from India. That means make in India. So that is why they are coming out with different kind of schemes under the production linked incentive, specs, or different kind of schemes wherein if you start manufacturing in India, so they are providing some kind of capital subsidy or revenue sales benefit under the PLI or different kind of schemes. Next is supply chain diversification. Just like in the last 2 years, we have seen during the COVID-19, there was huge supply chain issues, like for example, pharma products and different kind of products, which was necessary products. Like for example, such necessary products which we in India doesn't produce, or specifically like USA doesn't produce in their own country. So they started producing themselves, or they started giving benefits or shops to different kind of companies or countries, so that they start producing and manufacturing in their own country. So these are the emerging trends that are currently there and which India is also following. So the next is the type of trade agreements. There are basically 6 types of trade agreements that are there. The first is the preferential trade agreements. These basically the preferential trade agreements. Currently, in the current scenario, India doesn't prefer to sign the preferential trade agreements. The reason being, the preferential trade agreement was earlier signed by India. Specifically, the preferential trade agreements showcases the positive side, like positive list of goods that will be given concession in the rate of duty. But the free trade agreement, preferential trade agreement only gives a positive list. Free trade agreements gives the negative list. That means all the HSN codes, that tariff lines that are there, approximately 12,500, all the tariff lines will be covered in the free trade agreement, and only specific line items, only negative list will be there on which there will be no concession in the rate of duty. So that is the difference between PTA, that means preferential trade agreement, and the free trade agreement. Next is the framework agreement. Framework agreement is basically, it is signed by India and different kind of countries, wherein this specifies a future course. What will be the future course of the liberalization? Will they be going for the free trade agreements or different kind of trade agreements? Framework agreement provides, it's basically a future course of action in which what the country will be going forward to. Early harvest agreement is before the free trade agreement, because free trade agreements is a very big agreement, because you are ultimately giving tax exemption, you're ultimately reducing the custom duty, maybe it equal to 0 or just giving a concession. So that is why opening the whole economy, so the country feels rather than opening the whole economy at the initial stage itself, they first go for the early harvest agreement, in which they give slightly, for example, there are 12,500 tariff items. Rather than going for the whole tariff items, they go for only, for example, they only cover first 3,000 line items. So there is a huge difference between PTA and early harvest. In the early harvest, they will ultimately going for the free trade agreement, but it's an initial phase wherein they have selected only few HSN codes which will be covered in the tariff concession. Nowadays, what India is following is CECA, that means Comprehensive Economic Cooperation Agreement and Comprehensive Economic Partnership Agreement. India recently that signed the UAE-India Trade Agreement was a CEPA, a Comprehensive Economic Partnership Agreement. And Comprehensive Economic Cooperation Agreement is, in addition to the free trade agreement, the government also provides different other kind of benefits like non-tariff barriers. They are reducing the non-tariff barriers or giving trade facilitation. So free trade agreement only focusing on the goods, but comprehensive agreement, comprehensive economic cooperation also provides under all the economic law benefits or different kind of procedural or non-tariff benefits. Comprehensive economic partnership agreements covers the services also. So that is why what India signed with UAE was CEPA, in which it was covered. It was the widest range wherein India covered not only the goods, but also the services, digital assets, and government procurement. And there were so much to discuss for the UAE, and UAE agreement was signed in 88 days only. So because India is now so much keen to sign the free trade agreements and different kind of trade agreements, so that is why their energy in signing the trade agreement has been increased a lot in the last few months. So what are the provisions that governs the trade agreements? The first is the GATT, which is General Agreement on Tariff and Trade, in which the Article 24 provides that a member country of the WTO can sign the trade agreements in which because ultimately you are providing concession on the rate of duty to a specific country and not the whole world, but specific country. So that is why, because India is part of the WTO, they have to comply with the WTO agreements in which they have signed many kind of agreements. So GATT, that is General Agreement on the Trade and Tariff, it's a part of WTO agreement in which the WTO permits to negotiate the trade agreements. Because ultimately we are providing concession to a specific country or a region rather than the whole world. So that is why that is not compliant with the WTO agreements. So that is why there is an enabling clause in which the paragraph 2C specifies that a developing country can give concession to a specific country in which they are having the trade agreements, because ultimately it is in general harming the whole world trade. They are not providing the trade benefit to all the whole countries, but they're specifically providing to that country in which they are having the trade agreements. So that is why there is an enabling clause in which this specifies that a country can give specific preferentials only to that country in which they are having the trade agreements. Next is the GATT, General Agreement on the Trade in Services. GATT, GATT was focusing on the goods. GATT is focusing on the services. So GATT provides that in the case of services also, India can have, or a member country of WTO can sign the regional trade agreements. Next is the Custom Tariff Act and Customs Act, which is part of the India's government laws, in which Section 5 of the Custom Tariff Act provides that the government can provide or levy a duty which is lower than in general because of the trade agreement. So Section 5 under the Custom Tariff Act provides this, and Section 25 of the Customs Act provides a general exemption. It empowers the government in which they can provide exemptions, not specifically to the trade agreement, but also in general trade exemptions. So Section 25 is a general exemption section in which they can provide exemptions under the Customs Act. So trade agreements, what is the ultimate objective of the trade agreements? Because ultimately we are focusing on the one world, one market, in which we are providing the market access to each and every country with which we are having the trade agreements. So many of the countries have started negotiating the trade agreements. So they are, just like we have understood, there are different kind of trade agreements, free, preferential, and different kind of trade agreements. India in general have total signed 18 trade agreements. The first one was with the Nepal. Nepal trade agreements dates back to 1950. Nepal trade agreement dates back to 1950, in which the government not only provided the concession in the goods or services, but it was a peace and harmony treaty also, in which it was a wide range. It was a very short trade agreement covering like only 2 to 3 pages, but it was a very generic trade agreement in which the government of India as well as Nepal provided trade concessions in the goods and services, and also in general peace and harmony between the two countries. And then afterwards they signed with Sri Lanka, Thailand, Singapore, Korea, Japan, Malaysia, Afghanistan, Bhutan, Mauritius, and the recent UAE and Australia. So India signed up like after the Japan, which was a mega trade agreement, because Japan is a developed country, and apart from that, Malaysia is also, like after Malaysia, India signed with the Mauritius and UAE. Mauritius coverage was not that big, and UAE coverage was a comprehensive agreement. So after basically Malaysia, it was UAE agreement by which the government has given market access to that country. So it was a big achievement for the government of India by providing the whole market access and as well as concession in the rate of duty to that country. And the latest one, which was Australia, the Australia's trade agreement has still not been, both UAE and Australia trade agreement has still not been effective. It is expected the UAE trade agreement will be effective by mid of May or the first week of June. But the whole trade agreement is in the general, is in the public. So if a person wants to understand what exactly there is in the nitty-gritties of the UAE trade agreement, they can have a look at it on the Ministry of Commerce and Industry website. So apart from the bilateral trade agreements, there are different kind of regional trade agreements also, because for example, India has a bordering nation of many countries. So rather than going for the trade agreement with each and every country, they have a regional trade agreement. That means AFTA, that covers the Pacific trade agreements, Asia Pacific, SAARC, SAFTA, Asian countries, which is the bordering countries, and Mercosur. Therefore, the government has, rather than going for each and every country, they have provided the regional trade agreement. So in total, there are 18 trade agreements, and there are also different kind of free trade agreement, preferential trade agreements, and MOUs, and other kind of like basically MRAs. That means mutual recognition agreements, which is not that beneficial under the tariffs, but they are different kind of non-tariff basically benefits that are there under the MOU or different kind of agreements. So what are the key features of the foreign free trade agreements? The key feature is that the duties and the tariffs that are imposed in general will be reduced. Second, FTAs typically covers merchandise such as agriculture or industrial products, services, intellectual property rights, investment, government procurement, competition policy. So these whole coverage that are there are under the Comprehensive Economic Partnership Agreement. And also the rule of origin, because ultimately, if we want to understand how the product is being manufactured in that country, so the rule of origin is being considered by the Customs Act. So as we understood in the initial session itself, that how is India's current experience with the FTA? So India's experience with the FTAs currently has not been that good, because the exports, which was expected that it will increase after the FTA, because for example, after the Japan and India FTA, it was expected that India will be starting exporting to the Japan, but ultimately it didn't happen. Japan started to export to India, and ultimately there was increased imports and rather than increased exports. So India's current FTAs, the experience has not been that good. That is why the government is still resistant in going forward with the FTAs. And this basically this chart also displays after the trade agreement with Japan, the imports has been increasing, and basically the exports and import, the graph is still like the similar graph. There hasn't been an increase or much of a decrease. It's a similar graph between the import and export. And also with the Korea, that means after the Korea trade agreement, that this line shows after the Korea trade agreement, there was an increase in the imports and there wasn't much increase in the exports. Likewise, for the Asian trade agreement, there has been much increase in the imports rather than going for the exports. So this shows that India's experience with the trade agreements has not been that good. So that is why the government has started, rather than going forward with these kind of developing countries, they started focusing on the developed countries. So I'll just give highlights on we will be starting with the highlights of the UAE trade agreement, and then we will be going forward with the Customs Act. So basically what the recent trade agreement with the UAE showcases, that the government of India and the UAE are planning to go for the increasing their merchandise trade to $100 billion by 2030. They're planning to go and increase. Currently it is around $60 billion, and now they're focusing to reach to $100 billion by 2030. And the key highlights of the UAE trade agreement is UAE is set to eliminate duties on 80% of its tariff line items, which accounts for 90% of the India's export to UAE by value. That means 90% by value product will be they will be getting a concession in the customs duty. Generally, in majority of the products in the UAE, the custom tariff is 5%. So the customs duty on that product will be reduced to 0. For example, if we talk about textile and garments, India is a country which everyone believes has a great potential in the textile and the garments. But recently, what the trend we are seeing is Bangladesh, Vietnam, because of their cheap labor, affordable labor than India, they started overpowering India. They started increasing their exports in the textile and garment sector. So even in India, if we talk about, we are wearing Bangladesh, for example, we are wearing Bangladesh t-shirts or shirts. This showcases the Bangladesh has been increasing their exports, specifically in the garments and textile sector, because of their cheap labor. So that is why UAE and India have signed a trade agreement, and in the trade agreement also it is mentioned that on the export of textile and the garments, there will be 0 custom duty. Earlier it was 5%. So it will be giving a level playing field for the India's exporters, and they will be given the benefit of 5% of because ultimately each and every penny is important if we talk about the exports, because there is a huge competition, specifically in areas in which the price is only the consideration. That is just like in the initial class of the session, we have understood that India is still focusing only on the products which are income sensitive. That means there is a competition on the prices rather than going for the intellectual or technical part. We are still focusing on the products which are focusing on the prices. So that is why, because ultimately we are population based country, we are huge, so we are surplus population. So that is why textile and garments, gems and jewelry, leather and pharmaceuticals, these are the areas which have special focus in the UAE trade agreement, because they have been given specific concession in the basically the custom duty. Next is for the India's perspective. India has given ultimately India has given 90%. India is currently given 65% on the tariff items. 65% of tariff items they have given concession in the rate of duty, and in the next 5 to 10 years they will be expanding to 90%. Likewise for the UAE, currently it is 90%, and in the 5 to 10 years it will be going forward to 97%. And it will be benefiting the exporters as well as the importers, because for example dates, which is famous in UAE, the imports in India, the dates will be increasing. For example, gold. For each and every Indian, if they plan to go in UAE, they generally prefer to shop for like gold, because ultimately the purity of gold is better in UAE. So that is why there will be concession in the rate of duty if the gold is being imported into India. But India, because ultimately India will be becoming more dependent on the import. So that is why there is a quota. There only 200 ton can be imported into India in a particular year. This is mentioned in the free trade agreement. So now we will be understanding the certificate of origin, and this is the most important part in the trade agreement, because ultimately if you are taking the concession in the rate of duty, concession or example or 0% rate of duty, so how the government will be ensuring that the rate of duty that the concession they are providing to the exporters and the importers, there are actually no malpractices, there is no like routing of goods. It is coming from that country itself. So that is why a certificate of origin, rules of origin, has been defined under the CAROTAR rules, and also in each and every trade agreement, which specifies on what all conditions you can avail the benefit under the customs. So basically the certificate of origin is an instrument which establishes evidence on the origin of goods imported into any other country. For example, if you plan to import from Japan, the Japan exporter, basically the seller of the Japan will be providing a certificate of origin, which will showcases that product was manufactured or produced in that country, that is in Japan. So there are two type of certificate of origin. First is the preferential, as the other is the non-preferential. Preferential means that they will be given preferential in the Customs Act. Non-preferential means they are given preference in terms of non-tariff barriers or different kind of procedural benefits which are there under the trade agreements. So there are there are two type of preferential as well as non-preferential. So there is a site that is CEO. Basically the DGFT is the governing body which governs the foreign trade of India. So DGFT has been given the authority. DGFT is basically a department which is under the Ministry of Commerce and Industry. So the Ministry of Commerce and Industry through DGFT has given a platform in which for example, if I'm exporting from India, I have to issue a certificate of origin. I have to produce a certificate of origin. So through the DGFT, I have to get this certificate of origin issued, and then only the importer of that country will be able to get the benefit under the trade agreement. So what are the provisions under the Customs Act? Because as during the session, as I've told that the current issue that the government was facing was there were many instances wherein a specific product which is not even produced in that country was being routed through that country so that they can get the concession under the free trade agreement. So the Honorable Finance Minister in the budget speech 2010-2020 stated that it has been observed that imports under the free trade agreement are on the rise. Undue claims of the free trade agreement benefits have posed threat to the domestic industry. Such imports require stringent checks. In this context, they have issued a new rules, that is CAROTAR rules, as well as a new section was introduced, that was section 28DA. So I will be covering this section in detail and as well as the CAROTAR rules, so that what specific queries an importer or exporter faces practically we will be understanding through this section and also the CAROTAR rules. And then we will be covering the case study also, what is there, because these kind of specific rules which are ultimately a non-tariff barrier, they are making a stringent checks. If they're making a stringent check, so what happens is the trade partners generally the trade partners generally go against these kind of rules, because ultimately they are trade barriers. They are reducing they will be reducing the trade, because the importer has to go for additional compliances, additional procedures, documentation and information. So these CAROTAR rules were basically the different kind of trade countries have been against these kind of trade rules. So you'll be covering the section 28DA as well as the CAROTAR rules in details now. So section 28DA, which was introduced in the budget speech 2020 and in the union budget, which specifies, for example, if an importer wants to take the benefit, wants to claim preferential rate of duty through the trade agreement, they have to comply with these kind of specific compliances. They have to collect these kind of information as well as the documents. So we will be understanding each and every point in detail. First, if an importer wants to claim the benefit under the trade agreement, they have to declare that the goods qualify as originating goods for preferential rate of duty. That means when the importer files the bill of entry, they have to declare that the goods was originated from, for example, Japan. If it is on the self-declaration basis, because ultimately importer has been given the liability. Earlier, what was the case was, before this section was introduced, the liability was with the exporting country as well as the exporter. Ultimately, the exporter and the exporting country had to provide and was liable if there was a misdeclaration in the rule of origin. But now the whole liability has been shifted to the importer. Ultimately, if I am importing a garment from Bangladesh or Japan, I am liable to produce each and every evidence to the customs, and if I'm not able to, I won't be given the preferential rate of duty under the trade agreement. So first is I have to declare that I will be claiming the benefit under the trade agreement. Second, the most important, I have to possess sufficient information as regards the manner in which the country of origin criteria, that means regional value content as well as product specific criteria, has been fulfilled. This means that I, as an importer, have to possess sufficient information. Sufficient information, it's a very broader term which showcases that I have to understand how the manufacturing process was undertaken, what was the regional value content. Ultimately, the regional value content means that how they are following the rules of origin, how much value addition was there under the, for example, Japan, I'm importing from Japan, how much value addition was there in the Japan country. So this also I have to understand. And in addition to that, if there is a specific product specific criteria, I also have to understand it. So I have to understand how the whole process map has been undertaken by the exporter, what specific product process they are undertaking, the information on the costing, basically how much costing there was there in the Japan. So this is leading to non-tariff barriers. This is leading to difficulties for the importers, because basically a seller, an exporter from Japan, doesn't want to share these kind of information to the importer, because these informations will be given, if they will be given to the buyer, the buyer will be able to judge that what was the exact cost of the product. Because if the exporter is providing what was the regional value content and what was the exact cost of production, so this showcases that the whole, what was the value addition that is there in that country. So this is making the importer ultimately liable, and to produce these kind of information, the importers are not able to get these kind of information from the exporters. So when these rules were initiated after the budget, basically when it was initiated in 2020, in the starting 3-4 months phase, there was huge difficulties by the importers of India, because they were not able to claim the benefit. Everyone started to not avail the benefit because these kind of processes were not being able to take care. The next was they have to furnish such information in such manner as provided by the rules, that if, for example, if the customs authority wants to understand how they're fulfilling the rule of origin, they have to furnish such information. And also they have to exercise reasonable care as to the accuracy also. Not only they have to process sufficient information, but they also have to understand the accuracy of the information which they are processing. The next is the fact that the importer has submitted a certificate of origin. This is a very important perspective. A fact that importer has submitted a certificate of origin shall not absolve the importer of the responsibility. Just by providing certificate of origin, that does not absolve the importer that they have taken reasonable care. So all the responsibility has now been shifted to the importer. They have to take reasonable care, not only in possessing the sufficient information, but also the accuracy and truthfulness of the information. So where the importer has a reason to believe, basically where the custom officer has a reason to believe that country of origin criteria has not been met, he may require some more different kind of information from the importer, which the importer has to furnish to the custom authority. So what if the importer fails to provide such kind of information? If the importer fails to provide such kind of information, the custom officer will be going forward with the verification process, and they will be temporarily suspending the preferential trade benefits. That means the concession in the rate of duty. And if they're suspending the basically suspending the custom tariff, basically the preferential trade, so what they do, they will be going forward with the bank guarantee. If I'm taking a benefit of the customs concession, I have to also give the bank guarantee of the difference between the original rate and the trade agreement. So this showcases that if I'm giving a bank guarantee, it is ultimately leading to my working capital is being blocked into the bank guarantee. So these kind of, if the importer fails to provide such kind of information, they can either go for further investigation or temporarily suspending the trade, basically temporarily suspending the preferential tariff treatment. So what if the preferential rate of duty is suspended? The proper officer may, on the request of the importer, release the goods and on the basis of the security, that is the bank guarantee. So, and if for example, the custom authority has asked the importer to provide sufficient and relevant information, so basically the importer has to provide such information in 10 days. As soon as they ask, the proper officer of the customs ask the importer to provide sufficient information, additional information, so the additional information has to be provided in 10 days. Also, the request for the verification, that means if I'm taking the benefit under the custom concession, basically the trade agreement, my liability doesn't end there. My liability ends after the 5 years from the date of claim of preferential trade benefit. That means I have to have all the sufficient information as well as documents till the 5 years of claiming the benefit. So this is the 5 years is a very huge time. That is, for example, in the GST, in Income Tax and Companies Act, the government has defined for how many long years we have to have the books of accounts. So likewise, in the case of customs, if we are taking the benefit under the trade agreements, you have to have all the documents and the information for 5 years from the date of the claim of the benefit. And also there is because the whole section 28 DA as well as the CAROTAR rules, they have given huge kind of responsibilities and huge power to the customs. Even if the custom officer feels that there is no purpose in going for the verification, they can refuse to give the preferential tariff only in 3 following cases. First, the tariff item is not eligible for the preferential trade agreement. That means the tariff item was not even there in the the trade agreement. Second is the complete description of the goods is not mentioned in the certificate of origin. Third is there is an alteration in the certificate of origin. Ultimately, what happens is there is basically what the importer does, and it has been seen in the past also. The importer basically alters the certificate of origin and takes the benefit under the trade agreements. So if the customs officer feels that there is alteration, even without going for the verification, they can refuse the benefit under the trade agreement. Next is the certificate of origin is produced after the period of its expiry. So after the period of the expiry, if you are producing the certificate of origin, then basically the customs officer can refuse to go for the preferential trade tariff. So till now, if there is any question regarding the session that we have covered, you can ask right now. Otherwise, I'll be going forward with the CAROTAR rules. So Himanji, if there is a question, you can ask me right now. I can move forward with the CAROTAR rules.
Sir, there is no questions right now.
Okay, no worries. I can go forward with the CAROTAR rules. So broadly, the provision on the Customs Act, it mainly covers the preferential tariff claim, the origin related information, the acquisition of the information which has to be there with the importer, verification request by the customs, identical goods which will be covering in the CAROTAR rules, and there are miscellaneous very different kind of like procedures which are importer as well as the basically the customs officer will be fulfilling while following the preferential trade tariff. So now, because the Section 28 DA, it was part of the Customs Act. So the Section 28 DA also provides that the government, the CPEC, will be going forward with the rules, which will be providing in details of what specific rule of origin will be there and what specific rules an importer has to follow to take the benefit under the free trade agreement. So there are some kind of important terminologies which were there. The first is the goods wholly obtained. 90% of the goods are not wholly obtained. Wholly obtained means goods which are completely manufactured or produced in that origin country. For example, if everything is being produced in Japan, then it is goods wholly obtained. These kind of goods are generally which are produced from, which are majorly produced, not manufactured, but produced. For example, agriculture produce, mines, gold, which are basically originating from that country, that are goods wholly obtained. Next are goods that are not goods that are produced using non-originating material. That means, for example, if I'm exporting from India, so some of the product has been imported into India. For example, some of the raw materials has been imported into India, and some has been produced in India, and completely we are manufacturing the finished goods. So that are part of the goods that are produced using non-originating material. That is not wholly obtained, are required to undergo substantial transformation in a country for the goods to be qualified as originating. So what exactly is substantial transformation? So substantial transformation has been divided into three parts. The first is the change in the tariff classification, because in India specifically, the tariff classification is the HSN code has been, it is an 8-digit code. So if there is change in tariff classification can be in the heading part, heading, or different kind of headings. If there is change in the tariff classification, that is change in the HSN code, then we can call it the substantial transformation. Second is the domestic value content. Domestic value content means how much production or manufacturing was undertaken in India. That means 45%, 50%, 75% in terms of the value. The domestic value content formula will be understanding in the future session itself. So the value increase, the value addition in India, that we will be terming as domestic value content. Next is the process rule, because some specific processes, for example, chemical industries or different kind of industries which are involved in the processes. So there are specific process rules. So in these three cases, these three cases covers the substantial transformation. So next is the change in tariff classification. Just like I told you, they can be changed in the chapter level, heading level, or subheading level. That means because in India specifically, they are 8 digits. So there can be 4-digit change, 6-digit change, or 8-digit change. So it will be specified in the trade agreement that what specific, for example, the trade agreement specifies that there has to be heading level change in tariff classification. So that is why the trade agreement specifies rule of origin. It's a general rules. But the trade agreement will be specifying what specific criteria you have to fulfill. Then only you will be fulfilling the substantial transformation. Next, just like I told you, process rule, there has to be change in there has to be following a process. Cumulation and accumulation means, for example, India has a trade agreement with Japan and also with, for example, Bangladesh, and the product goes from Bangladesh to Japan and Japan to India. So ultimately, they are fulfilling 2 trade agreements. So there can be cumulation or accumulation of the value addition. So that is covered in the accumulation or accumulation part. So this is the whole substantial transformation that is wholly obtained. Wholly obtained means the goods was manufactured in that country itself. Regional value content means how much value addition was there in that country. Change in tariff classification means change in the HSN code. And in some cases, there are cases wherein the trade agreement specifies there has to be value addition as well as the change in the tariff classification. So what are the additional compliances that the importer has to fulfill? The importer, during when they are the importer is importing a product, they have to specify what is the certificate of origin reference number. What exactly is the reference number of the certificate of origin? What is the date of issuance of the certificate of origin? The originating criteria. That means it is wholly obtained, or there is a change in tariff classification, or the value addition is more than 35%. They have to specify when they will be filing the bill of entry. If there is accumulation or accumulation, or there is a back-to-back certificate of origin, these 6 criteria, additional compliances has to be followed by the importer. Also, they have to possess, just like I told you, they have to possess the information in the Form 1. Form 1 has been prescribed on the CAROTAR rules. They have to file the Form 1 when they will be filing the bill of entry. And they have to keep all the supporting documents for at least 5 years from the date of filing of the bill of entry. So ultimately, this is the whole compliances that a country importer basically has to follow. Authenticity of the certificate of origin, sufficient details, methodology of direct or indirect method, basically the regional value content, and then details of the value of non-originating material, and then they will be able to claim the benefit under the preferential tariff. So ultimately, from reading the whole perspective, what we have read till now and what we have understood till now, what exactly as a professional, like a chartered accountant, lawyer, or CS, how exactly we are useful in assisting the importers or the exporters community. What the trend from the last 2 years after the CAROTAR rules was being initiated by the government, what has been seen practically was that different kind of litigations, different kind of cases, different kind of stoppage by the customs, wherein the custom officer has been not only checking it thoroughly, but also taking extra efforts so that there is the importer is following the rule of origin, and the product specifically has been coming from that country itself. So that is why the importer in the recent past, from the last 2 years, if they're taking the benefit under the preferential trade or free trade agreements, they are facing huge kind of non-tariff barriers. These are basically non-tariff barriers because ultimately the custom officer are taking different kind of measures to safeguard the country of India, because they are giving the concession rate of duty. So in the recent past, in the last 2 years, there are many litigations at the customs and also at the Supreme Court to basically, first there were different kind of writ petitions also, because these kind of CAROTAR rules, everyone was it was not following the spirit of the law. So that is a different kind of like writ petition was also filed at the initial phase. And now currently what we as a consultant also we are understanding and facing, like importer are facing, and they are taking our help was during following the CAROTAR rules. For example, in the recent past itself, if I talk about one of our client instance, they were planning to import solar cells and panels, and recently the government of India has increased the custom duty on the solar cells and the panels from 20 and 40%. So that is why now they are looking for, they're looking to replace and import, not rather than importing from China, they're looking for other options like Thailand or Vietnam, with which India has trade agreements. So our role provides is, our role first is into the advisory part, wherein we can advise in providing the whole, we can associate and provide the supply chain, what supply chain benefit ultimately if they are importing from the free trade agreement, and following the CAROTAR rules, because we are the experts in the taxation and the customs law. So we will be assisting not only in advising, taking the benefit under the supply chain or different kind of trade agreements, we will be also giving and providing assistance under following the CAROTAR rules. Because if they feel, and if the custom officer specifically controls and stops their product at the customs, so it will ultimately lead to demurrage charges and different kind of harassment by the custom officer. So that is why rather than safeguarding ultimately the importer also they want to safeguard themselves. So we as a custom experts, so we can guide basically the importers in following the CAROTAR rules. So that is why in the case of our client, when they were initially importing all the goods from China, all the basically solar cells and the panels, now they're starting looking for other options like Thailand or Vietnam, and we're assisting in making their basically the chart and the supply chain, how they can route their benefits from these countries, and also following the CAROTAR rules, because each and every trade agreement specifies that how much value addition should be there in that country. For example, if we talk about UAE and India's trade agreement, it specifies that there has to be 45% value addition, because UAE doesn't have much manufacturing sites. They are majorly into the service sector. So that is why the India's government, they're taking specific measures so that to make sure that there is no routing, there is no like China, like people doesn't import from like China, then it goes to Dubai, basically UAE and UAE to India. So they don't want going these kind of routings. So that is why there is a 45% value addition. That means whatever, for example, if the product is 100 rupees, so 45 rupees value addition should be there in the United Arab Emirates. So basically this showcases that India is taking stricter measures to make sure that the CAROTAR rules and the preferential trades benefits is availed only in the genuine cases. So now you will be understanding the powers that are there in the custom authority, because a huge power has been given to the customs. They can either request for the information, they can request for the verification, they can declare a certificate of origin as inapplicable, they can ask further information from the importers, and the further information has to be given by the importer to the customs within 10 days. If they are not able to provide such kind of information, then they can go for the verification, or they can discard the preferential tariff. The other can be if the principal commissioner of customs feels that there are these kind of things doesn't fall, then they can, without verification, they can disallow the benefit under the customs and trade agreement. And also the most important part is, if the principal commissioner of customs feels and has rejected a claim of the preferential duty benefit, they can basically reject the claim on identical goods imported from the same exporter or producer also. Rather than rejecting only for that consignment, they can reject the benefits under all the consignments that are there. So next is the verification process, and afterwards, I because of the paucity of the time, I will be just briefing of the verification process, and then I will be concluding my the whole presentation and the session. The verification process, it's a very the verification process has been provided under the CAROTAR rules, wherein if there is a doubt by the customs, if the custom officer or the corporate officer has a doubt that they are not following the certificate of origin, the rules of origin, so what they can do is they can go for the verification process. Verification process means first they can ask for the information from the importer. Next is they can ask the information from the exporting country. That means, for example, Japan also, whether the certificate of origin is original, is authentic or not. And they can also ask from the exporter also. That means from the seller, how they are fulfilling the rule of origin, or how much value addition there was there, what manufacturing process was followed, what was the costing that was involved. So everything can be undertaken by the basically the custom officer. So because there was so much basically the power has been given to the custom officer. So that just like I told you during the session, because the power has so much power has been given to the custom officer, this is leading to so much complications and litigations at the customs. So I'll just give like a brief of the case study which was there. It was between Dilwara Steel Industries versus the Union of India, and on 19th July 2021. It specified that the custom officer, what happened was the importer took the benefit under the trade agreement and was given the concession in the rate of duty, but the custom officer felt that the rule of origin was not followed, the value addition criteria was not followed. So because there was a doubt, the custom officer went for the verification process. So in the verification process, there are three kinds of verification process. First is the doubt regarding genuineness. There is a doubt whether the genuineness of the certificate of origin is there. Second is the origin and criteria, whether they are following the origin criteria. The third is the random basis. The random basis means on the risk assessment, they are feeling that there can be a possibility that the specific product or specific consignment is not fulfilling the criteria of origin. So there are three parts to the verification process, and in the three parts, if they go for the random process, basically the section under the sections under the Customs Act specifies if they go for the random process, the importer doesn't have to provide the bank guarantee. But the custom officer went for the bank guarantee and didn't go for the provisional assessment because the importer was not giving the bank guarantee. And ultimately, the importer won the case and it was in the favor of the importer, wherein the bank guarantee, basically the Supreme Court said that it was on the random basis the custom officer has felt that they are not following the rule of origin. So in that case, there is no need of the bank guarantee, even if they are going for the provisional assessment of the custom duty. So this is basically the remedies that can be possible. And if there is a rejection, they can go for the commissioner appeals. And if they go for the commissioner appeals within the 16 days, and if they doesn't win in that also, it is not in their favor also, they can go for the High Court or Supreme Court under the writ petition. So this was all from my side covering the free trade agreements and the CAROTAR rules. In the recent past, in the last 2 years, we have, as a consultant has seen, there are many instances of custom litigation and difficulties which the importer feels and faced. And now basically the importers have started not availing the benefit of the trade agreement, because there have been cases of like the custom officer have been taking additional informations and how they are fulfilling the trade agreement criteria. So these issues arises and in the normal general business of different kind of importers. So in the last 2 years, there have been so much investigation and also advisory from the importers, from the consultant and professionals like us, of how they can fulfill the criteria under the free trade agreement as well as the CAROTAR rules. So this was all from my side regarding the free trade agreements and the CAROTAR rules. If any of the participant has any query regarding the free trade agreement or the CAROTAR rules, they can ask me anytime, even after the session also. So thank you all. Over to you, Hemantji.
Hello, friends. I think we are very lucky that this is a topic which is very rarely discussed in the seminars or webinars. So, Manas, we are thankful to you for enlightening on various free trade agreements, and more trade agreements are happening with various countries like recently UAE, Canada, I think Australia, and we need to look into these more. And similarly, CAROTAR rules are also very significant. So thank you for sparing your valuable time and volunteering to be mentor to all the members for later on also if there are any query. And second session, Pramod Narula also will be discussing a very important topic of PMLA and AML. I invite members to become speakers, to write books where the institute gives 500 rupees per page. So if one writes 200 pages, 1 lakh rupees is the honorarium. There are conditions applicable, like it should be original work should be approved by the committees. And with this, I would request Pramod and Hemant to take over the second session. And Dr. Salim, if he's there.
I'll just check, sir. I'll just check, otherwise I'll take it ahead from here, sir.
Yes. And if there are any queries in general from the participants about the committee, how they can write books, how can they be speaker, how can they expand their practices in non-traditional area, members can ask queries and we will answer them.
Thank you so much, Chairman, sir. Thank you so much.
Hemantji, you are on mute. Hemantji, you are on mute.
Dr. Salim, yeah.
Thank you, Manas sir, for a wonderful session. for sharing your expert and insightful knowledge on recent free trade agreements and CAROTAR rules. I appreciate your professionalism, the flow with which you carried out the session, and want to thank you for the points you made. We are really honored to listen to you, sir, and we'll look forward to hear to you again. Thank you very much, sir.
Thank you, Ji.
And it is, one thing which I forgot to say, he's son of our council member Hansrajji Chuk from Delhi, and the time which Hansrajji gave in his vice chairman with me of the Economic and Commercial Law Committee, and lot of initiatives comes from him. And Mr. Manas, your involvement is also required in that committee.
Definitely, sir.
Yeah, over to Ahmed, please.
Thank you very much, sir. So moving on to the second session, our next speaker, we are very fortunate to have CA Pramod Kumar Narula ji. I would just share a few words about his resume. Pramod ji is a fellow member of the Institute of Chartered Accountants of India, qualified in 1987 and FCA since 1982. Before that, he completed bachelor's degree in commerce. He has 34 years of work experience as a chartered accountant, concentrating on the auditing, direct tax laws, management consultancy services, and due diligence services.
कुछ भी नहीं घुमा सकते
Sir, am I audible?
Yes.
I'm audible, sir?
Yes.
He has completed various courses like AML anti-money laundering course conducted by ICI, qualified course of ADR in arbitration conducted by the institute, qualified self-assessment test for RERA refresher course conducted by the institute, done the refresher course of basics of international taxation, qualified proficiency self-assessment test for independent directors conducted by Indian Institute of Corporate Affairs in May 2020. I feel delighted to welcome CA Pramod Kumar Narula ji to share his thoughts on our final topic for the evening, compliance of PMLA and AML measures. Welcome, sir. Please carry on the session.
Thank you, Aman ji. First of all, just sharing my screen. First of all, I am thankful to committee of the Institute of Chartered Accountants and particularly Dr. Dukia ji, who has given me this opportunity, and he has encouraged me a lot for this. I have no words for his kindness, but the way in which he has encouraged me. Without the background and paucity of the time, I am coming to the topic. And before starting, just I would like to say, I have started the history of the PMLA, how this has been started. Sterling Seagrave, in his books, Lord of the Rim, mentioned money laundering was prevalent 4,000 years back before Christ, and explained how merchants and others find ways to hide their wealth, including ways of moving it around without being identified and confiscated. It means 4,000 years back before the Christ, this was prevailing and this was the problem since then. In the ancient time in Bharat also, when kings and Mughals were ruling, produced by farmers and production or trading by the merchants, find ways to hide to save the lagan. How the word laundering was emerged, we can see from this slide. The term money laundering was given by the mafia owner of the laundromats, a self-service laundry provider in the United States. People were thinking they are bringing the money and putting into the bank and carrying their business and withdrawing the money. There is some problem. Yes. Money laundering has been an international problem. And just I'm discussing one case. Capono's case, he was a white collar person. He is known well, a reputed person in the USA. In US alcohol was prohibited. There was a popular belief that Capono spent his entire life fighting with mafia, and Capono was not a part of the mafia. But Capono was the most famous Chicago gangsters. President Herbert Hoover declared him as a public enemy #1 and ordered action against him. Several government departments, including the income tax department, went behind him. Capono did not have even a bank account or any investment in his own name. We see in India also, there are many cases, the persons who are not having the bank account or they do the business. Capono claimed that he was claiming less than $5,000 a year. Therefore, he is out of the income tax net and not paying the tax. Details of Capono expenses were collected by the agencies. Ultimately, Capono was charged with and tried for the evasion of tax in spite of the purchaser's threat to the jurors and bribery offers, resulting in last-minute change of the entire jury. Capono was found guilty. In October 1931, Capono was sentenced to 11 years imprisonment and a fine of $50,000 US dollar, the severest punishment till then imposed for a tax evasion. After that, the series of the conventions were held. Firstly, in 1970, the US government passed the Currency and Foreign Transaction Reporting Act, requiring all banks to report cash transaction in excess of $10,000. The original limit was $1,000. But in practice, this provisions were misused by simply splitting the transactions to below $10,000. The process called smurfing. In 1986, the US government made attempts non-reporting a distinct criminal offense. It means every transaction they have to report above $10,000. First convention, Vienna Convention, was held on unlawful traffic and narcotic drugs and issue of the proceeds of the crime. There were a series of conventions and resolutions for which India has been the part. Strasbourg Convention was on the laundering, search, seizure and confiscation of the proceeds from crime and adoption of the recommendations of FATF. The Organization for Economic Cooperation and Development, OECD, Convention on Combating of Corruption in Public Office, means one topic was in every convention and they moved forward. G17 submits Paris and recommendation of FATF for combating terrorist financing. FATF in 1989, this body recommended 40 recommendations for combating the money laundering and particularly terrorist financing. The FATF recommendations are the internationally endorsed global standards against money laundering and terrorist financing. The Egmont Group, this was the financial FIUs group, and in this particular group, this recognized the banking system, because every banking, they recognize banking is the main source to launder the money. This FIU meet regularly to find ways of the cooperation, especially in the areas of information exchange, training and sharing of the expertise. What functions of the FIUs are? FIU receive, analyze and disclose information by financial institutions to competent authorities of suspicious, unusual financial transaction at international level. Every FIU operates under different guidelines. Most FIUs under certain provisions can exchange information with their foreign counterparts. One of the main goals of Egmont Group is to create a global network by promoting international cooperation amongst the FIUs. The Basel Statement of Principle thrust on the banking. Again, there was a thrust on the banking, and this earlier this group was for G10 and later on this was increased to 45. The Basel Committee has issued a statement on the prevention of criminal use of banking system for the purpose of money laundering. The recommendations touch the following aspects: proper customer identification, high ethical standards and compliance with law, cooperation with law enforcement authorities, policies and procedures to adhere to the statement. And in the practical life also, in the banking, when we are doing the bank audit, the Basel statements we sign. Banking supervisors must determine that banks have adequate policies practices and procedures in place, including strict know your customer rules that promote high ethical and professional standards in the financial sector and prevent the bank being used intentionally or intentionally by criminal elements. The Basel Committee has further issued an extensive paper on KYC, customer due diligence. The same are intended to benefit bank against its fight against the laundering. In addition, the Basel Committee in this statement strongly supports the adoption and implementation of the Financial Action Task Force recommendations, particularly those relating to banks. And indeed, the standard of customer due diligence be consistent with the FATF recommendations. The Basel Committee has introduced requirement for common equity leverage ratio and liquidation ratio. Starting of the journey of PMLA in India, in all these conventions and resolutions, as I told, India has been the part. So in India, firstly, the bill in 1998 was introduced in Lok Sabha. And later on, ultimately on 1st July 2005, this came into force. After that, major amendments have been made, and 6 times amendments have been made, and major amendments have been made during July 19 and 18. First of all, knowing what is the procedure and what is the compliances and how this have come, we must know what is the proceeds of crime, because all PMLA depends upon the proceeds of the crime and offenses of money laundering. What are those? The proceeds, during explanation, this explanation was added in during 2019 by the Finance Act. I am reading because this is very important. Proceeds of crime means any property derived or obtained directly or indirectly by any person as a result of criminal activity relating to a scheduled offense, or the value of any such property, or where such property is taken or held outside the country, then the property equivalent in value held within the country or abroad. Explanation for the removal of doubt. It is hereby clarified that proceeds of crime include property not only derived or obtained from the scheduled offense, but also any property which may directly or indirectly be derived or obtained as a result of any criminal activity relatively to the scheduled offenses. Scheduled offenses means specified in the schedules, Part A, Part B, Part C. There are 29 acts in this schedule deals, and particularly Schedule B deals, there is a limit of customs, 1 crore. If the case exceeds ₹1 crore, the case will be referred and will come under the provisions of the PMLA. In this particular, just I would like to specify, in Part A, there are 27 acts almost, and corporate frauds, Section 447 of the Companies Act comes, apart from other acts. Offenses of money laundering, whosoever directly or indirectly attempts to indulge or knowingly assist or knowingly is a party or is actually involved in any process or activity connected with the proceeds of the crime, including its concealment, possession, acquisition, or use and projecting or claiming it as untainted property, shall be guilty of offense of money laundering. The explanation was added by the Finance Act 2019. Explanation for the removal of doubts. It is hereby clarified that a person shall be guilty of offense of money laundering if such person is found to have directly or indirectly attempted to indulge or knowingly assisted or knowingly is a party or is actually involved in one or more of the following process or activities connected with proceeds of crime, namely concealment, possession, acquisition, use, or projecting as untainted property or claiming as untainted property in manner whatsoever. This is very important explanation. In the process or activity connected with proceeds of crime is a continuing activity and continue till such time a person is directly or indirectly enjoying the proceeds of the crime by its concealment or possession or acquisition or use of the projecting it as untainted property or claiming it as untainted property in any manner whatsoever. It means if you have earned the crime money or proceeds of the crime you have earned, it means they will not leave. You have to, once the money has been obtained by the proceeds of the crime, or you are having in the possession, you will be charged with the provisions, or you will come under the purview of the PMLA. What is the process of money laundering? Money laundering process generally comprise 3 stages: placement, layering, and integration. I'm not going into the detail. Finally, assumption, or there is a myth. If we wash the dirt of the money, that will be clean. As I told earlier, this will not be so. Once crime incurred and you have got the money, crime money, it means you will fall under the provisions of the PMLA. What are the punishment if any offense is committed of the money laundering? Normal 3 to 7 years, seizure of the proceeds of the crime and value of the property. If offense falls paragraph 2, that is the Narcotic Drugs and Psychotropic Substance Act 1985, punishment will be up to 10 years, and along with the seizure of the proceeds of the crime and value of the property under the narcotic drugs. Now the main thrust, after all the conventions, and this was recognized, source of any money laundering lies with the banks. Everybody comes in the bank. The main thrust was given on the reporting entity. The reporting entity, the PMLA defined. Reporting entity means a banking company, financial institution, intermediary, or a person carrying on a designated business or profession. Main thrust, as I told, on the banking companies was given financial institutions and intermediary. What are the various reporting entities? Banking companies, nationalized bank, private Indian banks, foreign banks, all cooperative banks, State Bank of India and associates, subsidiaries, regional rural bank. Financial institutions, as defined in section 45I of the RBI Act, and NBFCs also. RBI regulates, supervise all India financial institutions, namely Exim Bank, NABARD, NHB, SIDBI, IFCI, IDFC, IIBI Limited, and TFCI Limited. Insurance companies, hire purchase companies, chit fund companies, housing finance companies. Intermediaries, stockbroker, sub-broker, share transfer agents, bankers to the issue, trustees of the trust deed, registrars to the issue, merchant banker, underwriters, portfolio managers, investment advisors, depositories, custodian of securities, foreign institutional investors, credit rating agencies, venture capital fund, collective investment schemes, including mutual fund and association recognized or registered under the Forward Contracts Regulations Act, an intermediary registered by Pension Fund Regulatory Development Authority, a recognized stock exchange. It means all the financial institutions, intermediary, which deals with the finance and where the money can come with the sources of the crime, they have recognized, and main thrust was given on the reporting entities to report. What are officers to assist in the inquiry, etc. Officers of all the acts and departments which I read earlier, and custom and central excise departments, narcotic drugs, income tax authorities, member of the recognized stock exchange, Reserve Bank, Officer of Police, FEMA, SEBI, insurance regulatory authorities, forward markets, recognized associations, pension funds, Department of Posts, Registrar of Sub-Registrar, appointed under the state government, registering authorities, Institute of Chartered Accountants, Institute of Cost and Works Accountant, Institute of Company Secretaries, and other body corporate constituted or established under the Central Act or the State Act. So all officers are duty bound to provide the information or report to the and assist to the director and officers of the PMLA. This has also been given in the Act itself. No criminal or proceedings against the reporting entity, its directors and employees will lie. The main thrust and main points were recognized that because the sources of all the money, crime money, ultimately goes into the bank, to dud the wash. Reports by the banks to be submitted: cash transaction report, non-profit organization transaction report, counterfeit currency report, suspicious transaction report, and cross-border wire transfer report. Now, what are the details? In the cash transaction report, as in India we know, and many clients comes for depositing, I am having the cash and what I should do, and they all are already aware, if we deposit below rupees 50,000, the bank will not report. It is not so. There is if credit or debit exceeds rupees 10 lakhs in a year, even they are depositing rupees 50,000, lesser 50,000, the banks have to report if the transactions are in excess of rupees 10 lakhs. And transaction of rupees 50,000 also have to be reported definitely. Is the bank responsibility over once it reports that transactions? No, bank's responsibility is not over. Banks have to always analyze and have a watch on all the transactions. If they found any suspicious transaction, definitely they have to report to the FIU. Reports of CTAs to be submitted by 15th. In all cases, the reports have to be submitted by 15th of the succeeding month. And even if there is a nil report, the report have to be submitted. Non-profit organization transactions report. If the receipts of in any account is received by more than rupees 10 lakhs, the report is to be made. What are the non-profit organizations? Any entity or organization that is registered as a trust or a society under the Societies Registration Act, or any similar state legislation, or a company registered under Section 8 of the Companies Act. Reporting is must in all the cases, and 15th of the succeeding month is the last date for filing this report. The RBI and other all regulatory authorities have given the emphasis on the suspicious transactions. What are the suspicious transaction reports? This has been specified in the rules also. Suspicious transactions includes an attempted transaction also. You have not made the transaction, but you have attempted. That is a suspicious transaction, whether or not made in cash, which to a person acting in good faith gives rise to a reasonable ground suspicion that it may involve proceeds of an offense specified in the schedule to the act, regardless of the value involved, appears to be made in circumstances of unusual or unjustified complexity, or appears to have no economic rationale or bona fide purpose, gives rise to a reasonable ground of suspicion that it may involve financing of the activities relating to the terrorism. The report has to be filed in case of suspicious transaction within 7 days of identification as suspicious at the level of principal officer of the bank. Some examples are of the suspicious transactions: identity of the clients, false identification documents which could not be verified within the reasonable time, non-face-to-face client, doubt over the real beneficiary of the account, accounts opened with names very close to the other established business entities, background of the client, suspicious background or links with the known criminals, multiple accounts, large number of accounts having a common account holder, introducer, or authorized signature with no rationale, unexplained transfers between multiple accounts with no rational activity in the accounts, unusual activity compared to past transactions, use of different accounts by the client alternatively, sudden activity in the dormant account, activity inconsistent with what would be expected from the declared business account used for the circular trading. Nature of transaction: unusual or unjustified complexity, no economic rationale or bona fide purpose, sources of funds are doubtful, appears to be case of insider trading, investor proceeds transferred to a third party, transfer reflect likely market manipulations, suspicious off-market transactions. In terms of the value just under the reporting threshold limit in apparent attempt to avoid reporting, large sum being transferred from overseas for the making payment, inconsistent with the client's apparent financial standing, inconsistency in the payment pattern by the client, block deal which is not at market price or price appears to be artificially inflated or deflated. IRDA also has given the master circular, IRDA and SEBI and RBI and all other government departments. They have issued the circulars, master circulars, how they can combat the money laundering and take the steps of AML. IRDA also issued customer insisting on anonymity, reluctance to provide identifying information or providing minimal, seemingly fictitious information, cash-based suspicious transaction for payment of premium and top-ups over and above rupees 5 lakhs per person per month, frequent free look cancellation by customers, assignments to unrelated parties without valid consideration, request for purchase of a policy in amount considered beyond apparent need, policy from a place where customer does not reside or is not employed, unusual termination of the policies, frequent request for change in address, borrowing the maximum amount against a policy soon after buying it, inflated or totally fraudulent claim, for example, by some or other means, causing a fraudulent claim to be made to recover part of the invested illegitimate funds, overpayments of the premium with a request for a refund of amount overpaid, multiple DD, each of the denomination for less than rupees 50,000 for payment of premium and top-ups over and above rupees 2 lakhs per person per month. Media reports about a customer, information sought by enforcement agencies. All these in the PML rules, thrust was given on the suspicious transactions. If they will be pointing out the suspicious transactions, they will be able to combat the money laundering. Again, counterfeit currency reports. If any counterfeit currency is found in a bundle in a one transaction and 4 notes are there, they have to report and they have to lodge a FIR. And this report also has to be made within the 15 days of the succeeding month. Cross-border wire transfer reports. This is also, if there is a transaction of more than rupees 5 lakhs, the report has to be made in a foreign currency. The report has to be filed by 15th day of the succeeding month. Immovable property, registrar has to, if there is any sale of the property more than rupees 50 lakhs, the reporting is to be made. And this is the quarter report by the 15th of the month, succeeding quarter. Now, after recognizing the reporting entity, because every money ultimately comes in the banks or in the financial transaction for the financial transaction, the great role was given to the FIU, and at international level also, the all, as I discussed earlier, 164 FIUs came together. In this way, India also formed the FIU, who was India was also a part of the when this Egmont group was made. The main function of the FIU was to receive, process, analyze, dismantling information relating to suspicious financial transaction, and is responsible for domestic and global efforts against money laundering and related crimes. FIU is a body who administers, only receive the information and analyze and send the information with regard to the cash transaction report and suspicious report, any financial other transactions which they deem fit, these are to be reported. How they work? FIU has the authority to request additional information on the individuals or entities from banks and other financial institutions. FIU, an administrative body, does not investigate the case. FIU is responsible for coordinating and strengthening efforts of the national and international intelligence, investigation, and enforcement agencies in pursuing global efforts against money laundering and related crimes. It's an independent body and directly reports to the Economic Intelligence Council headed by the Finance Minister of the country. This is a chart how the FIU Ind is working. This is a reporting agency, and this coordinate between the different agencies: banking companies, financial institutions, intermediaries, RBI, RDI, SEBI, enforcement agency, IB, RAW, REIC, CBDT, DGFT, CBEC, ED, EOW of CBI, all foreign FIUs report to the FIU Ind, which is in India. And ultimately, after analyzing the information, again, FIU Ind sends to the relevant information for taking the action to RBI, IRDA, SEBI, enforcement agencies, IB, RAW, REIC, CBDT, and all the relevant agencies. After that, they take the investigating steps. While recognizing this banking channel, main stress to find out the person that was given on the customer identification and due diligence. In this way, the PMLA Act defined the clients. Client means, we know the general meaning of the client also, who engages in a financial transaction or activity, the reporting entity. The term also includes person or whose behalf the person who engages in the transaction or activity is acting. They have also defined the transaction. What is the transaction? Transaction means a purchase, sale, loan, pledge, gift, transfer, deliver, or the arrangement thereof, and includes opening of an account, deposits, withdrawal, exchange, or transfer of funds in whatever currency, whether in cash or by in check, payment order, or other instruments, or by electronic or other non-physical means, the use of a safety deposit box or any other form of safe deposit, entering into any fiduciary relationship, any payment made or received in whole or in part of any contractual or other legal obligations, any payment made in respect of playing games of chance for cash or kind, including such activities associated with the casino, establishing or creating a legal person or legal arrangements. They have also specified the document. Only certified documents are required for verification. They can be self-certified. Different documents for different types of persons, like individual, partnership, company, trust, beneficial owner. They have specified the documents. As we know, we daily deal with these financial institutions and banking channels. They require Aadhaar, PAN, partnership deed in case of partnership, certificate of incorporation, MOA, board resolution in case of a company, trust deed in case of existence of AOP or body individuals, resolutions to authorize persons to operate account wherever applicable. Client due diligence, RBI given main thrust on the client due diligence. And in the rules also, that no reporting entity shall allow the opening or keeping any anonymous account or account in fictitious name or account on behalf of other persons whose identity has not been disclosed or cannot be verified. This is a continuous process. Ongoing due diligence provides that every reporting entity shall exercise ongoing due diligence with respect to the business relationship with every client and closely examine the transactions in order to ensure that they are consistent with their knowledge of the client, his business and risk profile, and where necessary, the sources of the funds. This is an ongoing due diligence process. Every time bank has to take care, and if you find any suspicious report, they have to report to the FIU. Risk assessment also goes on. Every entity shall carry out the risk assessment to identify, assess, and take effective measures to mitigate its money laundering and terrorist financing risk for clients, countries, or geographical area, and products, services, transactions, or delivery channels that is consistent with any national risk assessment conducted by a body or authority duly notified by the central government. All these are the parts of the due diligence, and measures which the PMLA rules imposed, and every reporting entity has to take care of during their transactions made with any person. Maintenance of records of identity of the clients. Every reporting entity shall maintain records of the identity of its clients. Every reporting entity shall maintain the physical copy of the records of the identity of its clients obtained in accordance with Rule 9 after filing the electronic copy of such records with the Central KYC Records Registry. The records of the identity of the clients shall be maintained in a manner as may be specified by its regulators from time to time. Where the reporting entity does not have records of the identity of its existing clients, it shall obtain the records within the period specified by the regulator, failing which the reporting entity shall close the account of the clients after giving due notice to the client. For this purpose of this rule, the expression records of the identity of the client shall include updated records of the identification data, accounts files, and business correspondence. They will also keep the records up to 5 years after the transaction or closing of the accounts. The KYC policy shall include following 4 key elements: customer acceptance policy, risk management, customer identification procedure, and monitoring of the transactions. Know your customer guidelines. The objective of the KYC guidelines is to prevent banks from being used intentionally or intentionally by criminals elements for money laundering or terrorist financing activity. The RBI directed all banks to implement KYC guidelines for all new accounts in the second half of 2002 when this was introduced, and they gave some time in case of 2004 in case of other persons. Recently in 2006, they made the KYC guidelines somewhat practical also, and they made the amendments by introducing video-based customer identification process. Freezing and closure of the accounts, they have the power in case of non-compliance of the KYC requirements by the customer despite repeated reminders by banks, FIs. Bank may impose partial freezing on the such KYC on non-compliant accounts in a phased manner. While imposing partial freezing means they can give the 3 months notice and they will be freezing the debit. The person cannot withdraw the money, but they can deposit the money. Thereafter, bank may impose partial freezing by allowing all the credits and disallowing all the debits. After all these, the government of India has taken many steps to prevent the money laundering. And first of all, they introduced and they tightened the provisions under the Income Tax Act. In Income Tax Act, Benamidar provisions, unexplained investment, and credits, the section 68, they changed and they tightened particularly for this. The Prohibition of Benami Property Transaction Act 1988, Prevention of Money Laundering Act 2002, New Company Law 2003, and incorporation of Section 447 in Companies Act and concept of beneficial owner Section 89 and 90, and creation of SFIO department. Black money, undisclosed foreign income and assets, and Imposition of Tax Act, Fugitive Economic Offenders Act, banning of unregulated deposits, schemes, etc. Schemes Act 2019, issue of detailed master circular by RBI, SEBI, IRD, and other government agencies for combating money laundering. Now, what is the result? After taking all the measures and amendments in the acts, particularly in PMLA Act, they made the agreements with the foreign counterparts, and they made the agreement if the person or crime is treated as a crime in both the countries, they will negotiate and the other counterpart will cooperate for sending the person here. Mehul Choksi's case, was a fraud case, sale of lab-grown diamonds. Because of this, all efforts, jail in Dominica, Antigua. INX Media case and Aircel Maxis case, P. Chandram was arrested, now is on the bail. PNB scam, Nirav Modi in jail in London. UK court approves Modi's extradition to India. Status report in Lok Sabha. There was one report in the Lok Sabha and the statement was given. According to the latest information given by the Minister of State for Finance in a written reply to a question in Lok Sabha, 283 prosecution complaints have been filed. Properties worth rupees 18,866 crores have been attached. Rupees 18,000 crore recovered from Vijay Mallya, Nirav Modi and Mehul Choksi. This government has given the report. In December, Honorable Finance Minister Nirmala Sitharaman said, as of July 2021, banks had recovered 13,109 crore after sale of assets belonging to Vijay Mallya, Nirav Modi and Mehul Choksi. This was the belief that after doing the crime and after making the fraud with the bank, nobody will be caught. But the truth is now that anybody can be behind the bar. One status of the cases against political leaders was on the Aaj Tak news. 51 parliamentary MPs were charged. In 4 cases, they were trial. Investigation is on the 28 Parliament MP and 2000. In 1 case only, there was nothing was done. Only in 1 case. Now, ultimately, after going through all these measures and consequences, we should stop the money laundering. And being a chartered accountant or the accountant, in 2019, there was one report of FATF. Everything knows chartered accountant. And this perception is also with the agencies, the persons who are dealing or who are being investigated. First of all, they catch the accountant, you know everything. We should be refrained from all these practices. This is a message after going through the PMLA compliances, results, and particularly the steps taken by the government. We are the point, we are the person who can catch, who while doing the audit, everything comes before the almost, which are in the books before us. We should take an opportunity and measure. One section has also been introduced in this 12(1)(a), section is 13(1)(a), in which directors or authorities are having to get accounts audited by a chartered accountant in case of complexity. And we know nobody else other than the chartered accountant can vouch the source of the money of the crime, because this comes in the books. I will say thank you very much giving me this an opportunity. Though it's any question which comes in the mind, they can ask Hemanji. Over to Hemanji.
So one small question which I should have asked earlier.
Yeah.
Sir, regarding cash transaction reporting by banks.
Yes.
That limit of 10 lakhs debit or credit in cash.
Yes.
It's in a month or year, sir?
In a month.
That's in a month.
Yes.
And sir, regarding immovable property transaction of more than 50 lakhs.
Yes.
What is that provision, sir? 50 lakhs ka immovable property owner se what will happen?
Only the reporting is there. As we know, any transaction or registry is made with the sub-registrar, the notice comes, you tell the sources of the money. So this is the responsibility lies on the reporting entity, sub-registrar. They have to report to the FIU or concerned department. Definitely income tax. They ask the question for this. Many times the notices comes.
So previously there was a limit of 30 lakhs. Is it revised to 50 or that is a different limit?
PMLA rules, 50 lakhs have been given.
Oh, this is PMLA.
Yeah.
Thank you, sir. Sir, can you close your presentation so that I can wind up? This was a really good learning session for all of us, listening to an expert. I'm sure all of us will agree with me on this. Thank you, Pramod sir, for giving your time and sharing your expertise on money laundering, its prevention, and anti-money laundering measures. It was a privilege to listen to your expert views on the topic. Looking forward to hear you speak again. Thank you so much, sir. Thank you very much.
Thank you, sir.
Thank you.
I think Chairman and Vice Chairman not here, so I guess we can close the session. Salim sir?
Yes, sir.
Can we close it?
Yes, sir.
Okay. Thank you, sir. Thank you so much, all of you, sir.
Thanks a lot.
Session is closed, sir. Thank you very much.
Thank you so much, sir.